All right, well, hey everybody, Rob Satcham here from Feedback Wrench. We help small businesses go from good to great, and we love creating content around opportunities to maximize your investment. We're all about helping you keep more money, mitigate your taxes, maximize your ability to be an entrepreneur, and we love helping small business owners. Now, in this video, what we want to talk about are two ways on top of being an S Corp that you can drastically reduce your taxes. So I'm going to show you two tools or two ideas that are going to help you legitimately reduce your taxes. Now, there's lots of stuff out there that you're going to hear, but really what it comes down to is, as a business owner, you're able to mitigate your taxes when you put yourself in a position of offense in terms of financial abilities. What do I mean by that? You gotta be playing offense. You have to pay off your debt. You have to have cash flow and play offense if you're going to do the things that truly allow you to reduce your taxes big time. No amount of going through and trying to find additional deductions. There's nothing you can do to spend more money on things inside of your business that are truly gonna help you reduce taxes. There's only one core principle at play here. You need to be able to play offense. So you have to create financial margin in your life, which means you have to be financially wise. It means that you have to save money and pay off debt. So with that, there are two massive things or tools that you can use here. Another thing is I'm going to be talking to small business owners that are they don't have any statutory employees. So these are two ideas for people that are like freelancers. Maybe you're making $150,000, $200,000, or even like $80,000 in 1099 income or from your small business. Maybe you're a web designer, a consultant, a reseller, a broker of some sort, an insurance salesperson, whatever it is. You've got this, and you've seen our videos on S Corps, and you've seen how an S Corp can cut your self-employment taxes in half almost. Check those videos out if you haven't. This is two additional ways that you can drastically reduce your taxes. So if you're with me here, that's the two prefaces. One, you got to be able to play financial offense here. This is not for broke people or poor people. The second thing is this is for single owner S Corps and I'm coming at it from an S Corp perspective here, because I think in almost every case you got to do the S Corp if you're making net profits north of about 40K. But in this instance, you don't have employees. Maybe you have subcontractors and whatnot, but these two are for that. Now, to reduce your taxes, the first thing I'm going to show you is how to use a retirement plan as a single owner S Corp. Now, when you used to work for another company, right, a lot of people knew that you would have like a 401k if you worked for Best Buy or something, right? And you knew that if you put in a certain amount, they would give you this match or something like that. Well, retirement plans come down to, there are two sides to the retirement plan. You have the employer and employee contribution. So a lot of times in a 401k situation at another company, the employee contribution might have been that 4% match, or maybe you had a profit share contribution at the end of the year. Now you have SEP IRAs, simple IRAs, 401ks, and other, sometimes there's pension plans and things like this. For a small S Corp, maybe you're making $100,000 a year, you're doing like a 50 split. Not that that's what it has to be, but $50,000 in salary. We got to pay attention to the salary number here, and $50,000 in distributions. That's what we're going to work with here. So in this situation, you can use an individual 401k plan from Vanguard. There's other companies that have them, but Vanguard has a very strong product. In this plan, you have two sides of contribution, okay? Ultimately, in 2017, you can contribute up to $54,000 of tax-advantaged money into investment accounts. And in 2018, it went up to $55,000. And then you have a catch-up. It's either $60,000 or $61,000 if you're over the age of 50, okay? So bear with me here. I know this is kind of boring, but you have two sides to this. So you set up this individual 401k plan with Vanguard. The paperwork's a little annoying. You can't have any statutory employees. The costs are like $25 per fund per year. So you could pick like an S&P 500 index as kind of your generic growth one, and then you could pick like a retirement plan fund that a target year fund for the year that you turn 65 as more of your conservative, or the one that's going to dial down its aggressiveness as you get closer to retirement. So you could pick 2 funds. That's $50 a year. That's incredibly inexpensive. And then Vanguard uses passive index funds that have super low fees. This is just a great tool. But here's how it helps you save in taxes. You can save drastically. So when you set this thing up, you have this $50,000 salary in this instance, right? You're going to be able to do up to $18,000 plus a catch-up if you're over 50. So if you're over 50, I always have this catch-up amount. But you can do up to $18,000 in this plan, and you can set it up to be Roth. And remember, if you do a Roth contribution here, up to $18,000 in Roth. That's huge. That means you're going to pay taxes now, but then when you draw it out, it's going to be tax-free, right? Or you can do your traditional IRA where you're going to deduct it in this year, and then when you retire or draw it after age 59 and a half, you'll get taxed in it. Traditional is what you want to do if you feel like your income's kind of a little bit lower now than what it's going to be in the future, or if a lot of people like Roth for flexibility, but you have up to 18 grand. So you're wondering how to do more Roth contributions? This is how you do it. You can do up to 100% of your income. So if your salary is only like 12K or 10K, you can only do up to that amount. But you can either do Roth or traditional. Now this side, this employer contribution you're doing in this, essentially is done after self-employment taxes, right? Because it's done with the salary or the payroll side. So you've paid your self-employment tax. Then if you do traditional, you're not paying your state and federal. If you do Roth, you are paying it. You gotta wait till age 59 and a half to play with this. A lot of entrepreneurs don't like this, but this part is kind of tax advantaged. Now the employer side, folks, this is where you get huge tax deduction compared to regular people. So the government wants to induce corporations to invest for retirement. So what they do is, in this case, this individual 401k, you can take from between 0, obviously, and 25% of your S Corp salary and do what's called a profit share contribution. So between up to 25% of the S Corp salary, you can do as this contribution. Now, between the employer and the employee side, you can't go over the limit of 54K. But 25% of 50K, I think, is like $12,500. That was the math I think I did earlier. Forgive me, I'm not thinking right now. I'm just talking to the camera here. But in this case, you get to do a straight deduction from the corporation into this retirement plan. In essence, this is a way to get money out of the corporation without paying your state and federal income tax. This means you've saved, almost $2,000 of self-employment taxes in essence. Forgive me, I know it's not 100% correct, but this is a great tax deduction, okay? That's a straight write-off in the business, $12,500. Now you can do that even more, but it's tied to your salary. If you were an LLC, it's tied to your net income on the Schedule C, so you can actually do larger contributions here, but this individual 401k allows you to pump tons of money. You can save it for retirement. It's by Vanguard, low fees, great index funds, it's great. But you get this employer side. You can choose between 0 and 25% to contribute as this profit share, and you're getting huge tax deductions. So that's the first one. Check out Vanguard.com and their individual 401k. Remember, if you got employees, this doesn't work. So that's the first thing. Now, the second massive tax planning opportunity you have as an operating S Corp is in real estate. Now, what I'm going to do here is I'm going to show you an idea that you could do as a smaller S Corp. Let's just imagine that you don't have any employees. It's just you, but maybe you want a place that you can call your own, right? There's so much more to talk about with this that I'm not going to get into right now, but real estate is where all the tax planning is done. If you own businesses, if you own housing is really what it is. You're providing housing to people. The government says, we want that. You want to know how Donald Trump didn't pay any taxes? He owns businesses which provide jobs, and he owns real estate that provide housing and business infrastructure, right? So the government has given us this ability to get tax advantaged opportunities when we get into real estate. So here's some ways you can do it. So I just put out a video that talks about never putting rental real estate. I'm talking buy and hold rental real estate here. Never put it in an S Corp, okay? But here's an opportunity that you could do. Let's just say that you wanted to get into buying a property that's going to be for rental. One of the best types of properties you can get into is multi-unit housing, specifically duplexes, triplexes, and quads. They're a little bit easier to finance. There's some more things you're going to do here than just choose a property and do it. But let's just imagine you bought a duplex, and when you go looking for this duplex, you find one, either A, that it's going to be all right for you to use one side as your office, or B, it's multi-unit for commercial. You got to pay attention with this. You know, go to the duplexdoctors.com, theduplexdoctors.com to learn more about duplexes, triplexes, and the power here. But let's just imagine you spent, $400,000. Now, when you buy, you're probably going to borrow, right? When you buy this property, buy this duplex, you're going to use after-tax dollars. The corporation doesn't get to deduct any purchase price or down payment on a property. That's out of the question, okay? You have to have this cash saved up. You have to put the down payment down. But what you're going to do is you're going to own this in an LLC, and then over here, you're going to have your S Corp, right? So you have two entities. Over here is where you're doing all this action. You're reducing your taxes with an S Corp. You're using maybe an individual 401k plan. Now over here, you buy this duplex, and in one side, you're going to find a great tenant, and you're going to rent it out. Now you had to buy it with after-tax money, but now what you're going to do is rent out one side, which produces income, rental income, right? And a lot of times in a duplex or a triplex or a quad, that rent can be a huge portion of your mortgage payment. Now on the other side, you're going to set up, and this has to be legit. You have to have documents that legal documents for this lease I'm going to show you. Don't just haphazardly do this. You have to protect yourself. You have to do it in a bona fide way. But on this side, you're going to do two things. One, you're going to set up an office for your small business, a 100% use office. That means nobody lives there. You're going to use it for an office. Maybe that's not the best use of this. Who knows? But nights and weekends, you're going to do maybe Airbnb or short-term rentals. So nights and weekends, you've got somebody able to stay there. During the day, you use this as your place where you run your S Corp, which allows you to pay a lease, a reasonable market value lease from your S Corp over to this every day or every month, okay? Here's what's cool about this. Remember, LLCs and passive income, this passive income in this LLC is not subject to to self-employment taxes. So this S Corp, you pay this lease over. You have to do this properly, okay? But let's just say the market value is that you'd pay $1,500 a month over here. That $1,500 a month is a deduction within the business. That's a legit thing as long as you're doing this properly. That means you're not going to pay SE tax on whatever amount this lease is. You're taking it from something that is subject to self-employment tax, going over here where it's passive income. Now, that's great. We're going to save in self-employment taxes. Now, you have to remember that the government has said we want housing, right? So, in this instance, we paid $400,000 for this property, right? We get to do what's called depreciation. There's a couple things you can do. You have depreciation, then you even have what's called cost segregation. But we've got the lease coming in. We've got rental income coming in. And let's just say that the value of the property, that's not the land. So you can take the value of the property, everything except for the land, and you can depreciate that. So here's what that means. You're going to take this $320,000 and you divide it by 27 and a half years. So you're going to be able to depreciate $320,000 over 27 and a half years, or 29 and a half, or 39 and a half years for commercial property. This is where it gets kind of dicey. But when this income comes in, you get to take that depreciation. Let's just say maybe it's like $11,000 a year. And whatever that income is, not only did the S Corp take its SE taxable stuff and put it over here where it's not subject to SE. But now the depreciation is going to offset that income again. So now you have another tax advantage. Now when you do depreciations, if you ever sold the property, you need to do the proper exchange and buy a like-kind exchange essentially. Otherwise you're gonna have recapture on that. You gotta be careful with this. There's lots of advice to go around here. Contact nuancefinancial.com to talk more about this, but this is a great opportunity to do huge tax planning, folks. So the three massive ways you reduce your taxes: one, you become an S Corp. You have to then be in financial position to play offense is really what it's about. Take a look at the individual 401k or even retirement plans. If you have employees, retirement plans can be a good way for you to obtain their services and put kind of the golden handcuffs around them in a tax advantaged way. But for this case, this is for people that don't have employees. Look at the individual 401k. You have the employer and the employee side, employer profit share side up to 25% of your S Corp. You're essentially not paying self-employment taxes on it. You can't touch that money until you're 59 and a half. And you have that other side that was up to $18,000 of either traditional or Roth or up to your salary. Then you have, take a look at having a building that you own that your S Corp leases from. That lease dollar, when done properly and it's within the guidelines, is going to be moved from a business where it is subject to SE to where it's not. Check those two opportunities out. They can save you big time in taxes. I'm Rob Satcham from feedbackwrench.com. Hopefully that helps you keep more of your money. Like and subscribe if this is helpful. Have a great day.